Well, thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah, and our guest today is a gentleman who's been on the show a number of times, of course, but runs the largest Cat3 AIF in the country. Andrew Holland needs no introduction. Joins us on the show. Andrew, from your home or from your office? Because I presume, as we spoke about, you started going to office a bit.
Yeah, from home this morning, and then after this interview, which thank you for inviting me, I'll be heading off to the office.
Okay. Now, the pleasure is always ours to have you, Andrew, and your valuable opinion. So tell us, Andrew, we'll come to India in a bit, just a couple of things, a couple of opinions on the global side as well, since a lot has happened between the last time that we spoke and this time around. One, the Fed has said what is said, and Jerome Powell in yesterday's testimony as well, speaking about his point on how inflation might be not similar to what it has been in the past. But also, Andrew, the other pocket of how the consumer seems to be coming back. Highest number of passengers screened on US airports since March 2020. US existing home prices having an unprecedented run, so to say, and which actually buoys the consumer confidence quite a bit. How do all of these stack up?
Well, it kind of leads us to complacency, actually, in terms of this Goldilocks scenario of the Fed doing no wrong. I mean, he becomes hawkish, and the narrative around that is that listen, it's going to be positive because potentially a higher interest rate, albeit small, will probably dampen down growth going forward, and therefore, as the supply chain comes on and so forth, commodity prices and other input prices will fall. Therefore, inflation will fall as well. It sounds too good to be true, and sometimes it can't be that way. My feeling is this: is that yes, you're going to get, as across Europe and in the US, you will see this spending moving more towards travel and vacation time. But if you look at some of the recent data, whilst you mentioned about house prices reaching new highs, that's correct. But house sales and retail sales have been falling for the last few months. So I'm just wondering, by September time, once people start going back to work more often, the schools start. I'm talking about US and Europe, obviously. Will people spend as much, or will they save? And I think that's one of the key factors which could derail this whole growth story, global growth story in the short term. Because if you do see a slowdown in growth, there's not very much ammunition that the Fed has to keep the economy going, and therefore you could see a growth shock to earnings. And given the high PEs that we have globally, you could see a retrace from the highs that we have at the moment. So it's probably more of a late summer kind of variable to look out for, but it's a concern to us. I think we'll keep debating about inflation for the next 2 months, but I'm kind of in that camp as well. It's probably more transitory at the moment, unless wage growth starts to pick up over the next 2 months, because that usually leads to stickier inflation going forward.
It's interesting. Yesterday, I think UBS or one more note spoke about how while there could be issues around either growth or inflation or both, but earnings growth for the S&P 500 companies looks so strong that it could actually provide a bit of a cushion if indeed the S&P were to correct a bit. What are your thoughts on the US earnings growth and the resultant impact that it has on sentiment across the world?
Well, I think most of the trades, if you've been looking more recently, have been geared towards the kind of tech companies or IT companies again, because that's where you will see some growth. But if you've seen the banking sector in the US has actually put out a lot of warnings over the last 2-3 weeks, mainly in the counter trading for sure. M&A is still very strong, but that's a big significant drop in earnings. I'm not saying that you won't have earnings growth. I'm just saying that you could see the expectations start to be knocked down, and that's not what the market's expecting at the moment. It's growth everywhere, helped by lower interest rates, which will continue for some time. and also infrastructure spending. And President Biden is still yet to get that bill through. So all of this could play, as I said, into a September kind of concern. I'm not saying you're going to get deflation or recession in the US, but you could certainly get slower growth.
Okay. Andrew, what does all of this do for the emerging market pack? It almost seems as if decisions these days about what the markets will do are being taken by technical factors. One, what yields could do and the resultant impact on PE multiples, or if the DXY were to strengthen from 90 to 92 to 94 to 96, then what the resultant collateral damage it could bring, or volatility, and which could hamper what could happen to EMs. It almost seems it's a market that is more focused on technical factors as opposed to fundamentals.
Yeah, and that's what happens when you have a lot of liquidity sloshing around. We're going to go back to more shorter term kind of themes that play out. So now you have a stronger dollar, which I think was probably more of a risk-off trade, for a lot of investors in emerging markets. So hiding the dollar. But if I'm correct, and if the Federal Reserve is correct that it's inflation is transitory, then you could see bond yields continuing to ease off from here, which would probably mean that the dollar will weaken as well, and emerging markets will enjoy more inflows. So what I'm thinking is that over this kind of called summer months in the Western world, is that the economy continues to run hot in the US. The Fed does nothing about it, and the markets will continue to try and play the positive of lower interest rates and this kind of nice soft landing for the economy with growth until maybe September. So maybe the next few months are still kind of liquidity driven markets where asset classes continue to do well.
Interesting. What about India and the fact that our Achilles heel, which is crude oil, almost everybody and every single broker worth his salt is talking about estimates of higher crude prices for the better part of FY22 or the remainder of 2021. What's your thesis there? Could it meaningfully damage prospects for Indian markets or not quite?
Again, we'll probably kind of live through it in the very short term. Because again, liquidity just blinds the kind of fundamentals. From the markets. A lot of this will obviously be, people traveling within their own country. In the US, for example, a lot of people are using their cars and traveling around. It's a usual factor during the summer months. And that's the same across Europe as well, because, the borders are still not fully open. So it could be more temporary over the summer months as people travel more. But, the market doesn't want to factor in. I've seen forecasts for $100 of Brent over the next 1 year. If I go back to, I think last time before the markets fell, I think the market, back in 2008, right, wasn't the oil price around 140? Our markets were hitting new highs before that. So when liquidity is there and growth is there, people tend to kind of walk past the fundamentals.
Okay, a small dwell towards the micro. We were speaking to JP Morgan yesterday. We were speaking to some others over the last 3 or 4 weeks. And we were speaking to Oil India yesterday, Andrew. And the companies, as well as the people who estimate the earnings of these companies, the upstream companies, there are a handful actually, just a couple of them. And there may be some downstream companies, etc. But everybody's talking about how the earnings picture for some of the upstream companies may change quite significantly. And that while it's a handful, it is still a good place to bet on, simply because the downsides are protected and the upsides seem to be very, very strong. Are you looking at oil and gas closely? One is the divestment plays and one is the other upstreams.
Yeah, no, I mean, we haven't changed our overall view about India as an economy as it reopens, that the sectors which will be the banking sector, obviously, but energy would be one of those sectors as well, along with discretionary consumption and industrial. So nothing's changed from that. It's just you'll have these themes playing in and out over the time. I would say that as oil prices move higher, whether there will be any government intervention at some point, which we've seen in the past, wouldn't surprise me. To see that the government might step in to try and keep prices a little bit lower than they are today, given the forecast you just mentioned. So, whilst I like the sector overall, I'm always wary that it's a political debate as well, which can obviously have its own implications, as we've seen in previous years.
Yeah, man. That's probably one problem that people have with these, right? Who knows? The government levies some bit of burden on these upstream companies. I doubt it'll happen on downstream since the divestment of BPCL is on the cards, but let's wait and watch. Andrew, the other thing is what a lot of people are confused about banking. While the conversation around rising NPAs has gone away because of the provisions made, I mean, the credit growth for some of the select banks has actually done really well. In some cases, outpaced GDP growth for a variety number of years as well. Do you reckon as the economy opens up, BFSI remains a pocket to be firmly invested in, and not just from a benchmark perspective? Assuming that you had no benchmarks to obey, Andrew, would you still be comfortable holding larger dollops of BFSI?
I definitely think this is the whole financial industry, whether it's from the banking sector through to asset management, through to insurance, is a place to be over the next 2 to 3 years. If the economy, which is $3 trillion today, is going to get to that 5 trillion, you've got to have a bigger financial sector than we have at the moment. And I think all of these will throw good opportunities across different areas. Savings, for example, in terms of asset management companies. We've seen the figures, right? I'm not going to go through them. Them in terms of the SIPs and savings, which are going more towards the markets. It's good news longer term. So, to my mind, I think the financial sector, will have its, again, its problem areas, but sticking with the quality ones, I think you're going to do very well. There's a lot of interest, I think, from foreign investors in, whether it's from credit cards to insurance. At the end of the day, we're all probably after, the COVID recedes completely. Health insurance, is going to be one of the big growth areas, for India over the next, for many, many years to come.
Andrew, a bunch of, how do I say, a bunch of moves done by the government in the last few days, weeks, months, right? PLI was the poster boy, but a bunch of other things done. So privatization is, of course, a step. This whole bioenergy movement is a step. Banking reforms have always been on the forefront. Anything at the smaller end of the market that has really made up and say that, hey, this is something that is really positive, or this is something that's really negative, and let's alter our positions here?
No, I mean, I think there's nothing wrong with the, doing the right things, right? I mean, the budget, was one of the best budgets I've seen in India. And if the government can follow through on its infrastructure spending, then that will have that kind of multiplier effect for the economy going forward. But it takes its time. It'll take a number of years for that to happen. I think the red flag that I would put out there at the moment is the rise in mid and small caps. Now, undoubtedly, there's going to be some very big winners from this category. That's for sure. But I don't think you can paint every company with the same brush and say that they're going to be a real winner going forward. And I think that's what the market's doing at the moment. And so that's a red flag for me. It always is when you get everyone telling you I've made so much money in this stock and that stock, and you've got to buy this. It's usually the top of the market. I think the other thing as well is that one of the GDP is currently around 115%. Now people will tell me, "Oh, Andrew, it's okay because GDP will start picking up." I can't be certain of that, but anyway, anytime it's over 115, if you look back, there's always been something global or local which has happened to bring that market cap back below 100 again. So it's just a red flag for me in the very short term that things are starting to kind of heat up. High net worth individuals, retail investors are all playing in this market, and they'll be the first to exit once markets turn down. So those are the red flags which worry me. And of course, I think a lot of the pain would be in the more the mid and small caps where you get disproportionate rises in share price and on the way up, and equally as bad on the way down.
Are you sitting on larger portion of cash than what you normally would be, Andrew?
No, we've been deploying. I mean, obviously keeping hedges reasonably high in the past week or so, because of obviously the Fed and the implications from that. But now it's started to die down again, and we're back to the Goldilocks scenario of liquidity and interest rates remaining lower, and no problems in the world. The markets will continue to enjoy that run along with the global markets. So we have been deploying more in the sectors I mentioned before, in terms of banking, industrials, energy, and consumer discretionary. So haven't really moved away from that. The reopening trades, unfortunately, a lot of the companies there fall into the kind of small and mid cap, so it doesn't necessarily meet our funds requirements. But I do expect, say for the hotel sector, for example, they will have significant pricing power, particularly in the short term, as we all want to travel and get out and do something. But that will start fading away as soon as things start to become more normal.
Yeah, it'll be interesting to see. Already the pricing for some of these hotels are high, and I think we're seeing that airline for come back. I just wondered, Andrew, one last question. So while, how do I say, while it might be difficult to invest in businesses which are in the direct line of fire or the direct line of benefits from the reopening trade and hardcore correlated, right, like theaters or hotels or airlines, would ancillaries out there be worth looking at? Because software companies servicing airline names or hotel suppliers or movie production houses, which will see not just the OTT platforms, but now even theaters starting to display as we open up. Would those be better ways to play the reopening trade?
Possibly. It's a good thought. Some of these companies, would fall into that mid and small cap category. So it's not some of those companies I may not be familiar with. But I would say the best way of playing the reopening trade is to be very selective in where you think the long-term prospects will remain. So, for example, I would have thought, even though the hotel prices, hotel sector has had a good run recently, that there'll be one or two well-known branded hotel companies which will continue to do well. And don't forget, we're just talking about the reopening within India of people traveling. Once we have foreign tourists again coming back, it will help that pricing power, for them to have that operational gearing impact, which will be a significant increase in profitability going forward. I think the theme that I would continue to kind of play on, which is not necessarily just a reopening trade, is to remember that India has 130 billion people who are considered millennials. So if you take that as being your spending power over the next 4 to 5 years, it's going to be a lot of discretionary spending going forward.
Yes, indeed. Well, too many uncertainties, too many balls up in the air. Let's hope let's see how they all settle down. But Andrew, this was lovely to get a sort of an in-between conversation with you. between events to figure out how you're thinking about this. Look forward to having you, of course, again, hopefully before any tumultuous event happens. Thanks so much for joining in today.
Thank you for having me again. Always a pleasure.
Pleasure was ours. Yeah, pleasure was ours. Viewers, thanks for tuning in to this leg of The Talking Point.